So any sort of introduction? This is Brett Raker, extraordinaire at everything.
Extraordinaire at everything? Or is there... I feel like there's...
I think we'll just let the words speak for themselves.
The words speak for themselves. Okay. I want to also start off by saying that neither of us are giving anyone advice on what to invest in or how to really invest. This is just what we've learned so far.
Avoiding a lawsuit.
I'm not trying to tell anybody how to do anything. Just simply what Brett and myself have done so far. I asked Brett to come on because he's taught me a lot about investing over the past few years and got me interested in investing, and is just the most knowledgeable person our age that I know that invests. Let's begin this segment. Very exciting, titillating stuff. Let's first start off with some buzzwords so that way we can understand moving forward what things mean. Dividends, like what's a dividend?
A dividend is basically when you buy a stock, you're buying a share of that company, like a percentage of ownership. And you receive kind of your profits either when a company makes revenue and profit, they have gross margin, they make $10 million gross margin per year. They can decide what to do with that. We're going to invest this into the future, put this back into the company, invest and expand. We're going to pay this out to the investors through a dividend, something like that. So that's what a dividend is. It's a company giving their investors, the owners of the company, the profits that they earned. And
then just to get even more simpler than a dividend, what is a stock? And then my follow-up to that is, what is a bond? Because I feel like those are the two things that everybody hears to invest in are stocks and bonds. So what is a stock and what is a bond?
All right, well, stock, also called a security, is a share of a company that you are purchasing. It's pretty simple. They're traded on an exchange, and you can purchase one, and now you own X percentage of the company.
So
at a certain price.
Would one go to buy a percentage of this stock? Like, you can't just go to a grocery store and buy a percentage of a stock.
Yeah. So an everyday investor like us, we're not buying it on the primary market. We're buying secondary shares that are already sold and resold.
Okay.
So you're going to use a broker. You're going to use a brokerage app like E-Trade, Charles Schwab, Robinhood, Fidelity. Yeah, the list goes on and on and on. But it doesn't really matter which one you use. It serves the same purpose regardless.
So when you're talking about a secondary market, what is that?
So stocks are initially offered, and then there's secondary market where they're offered again. You're buying it from somebody who's already bought the stock.
When I purchase a share through my investment account through Fidelity,
yes,
I'm buying it on the secondary market because Fidelity already possesses that stock.
Somebody else possesses that stock. It's connecting buyers with sellers is how the stock market operates. Right. That's how prices are determined. That's how you buy and sell. I say I want to buy 10 shares of Apple, and somebody's also selling 10 shares of Apple, and it's connecting us, and I'm receiving shares. Someone's selling them through the brokerage app, and I'm buying the shares through the brokerage app, and they're the intermediary.
Gotcha. Mm-hmm. And then does the same thing apply to bonds? Do you buy and sell through the same place? And what exactly is a bond?
A bond is a contract. So there's different types of bonds. There's corporate bonds, there's municipal bonds, and there's government bonds. And they all pay out different rates over different periods of times. And there's very complicated bonds and there's simple bonds. And the bond market is basically considered a risk-free way to earn a certain percentage of money. You're going to see a bond yield, like a 10-year yield of something like 1-2%. And you can go and buy that, and that's what you earn over the time. And basically, so a corporate bond is when a corporation needs money. Sometimes it's easier than to go to a bank and say, hey, JP Morgan, can I get $100 million at a certain rate because I need to grow my company? Instead, they can offer a bond out to investors, the public, and the public can buy up that bond, and it might be a lower rate, more advantageous for the company. And the investors are giving them money up front. They're paying the price up front. And then on the back end, they're receiving the coupon payments or a payment at the end or whatever it is, depending on how the bond is structured.
So what is a coupon payment in contrast to a dividend?
It's basically the rate on the bond. So if I put $1,000 into a bond and it has a 5% coupon payment twice per year, that means I get $50 twice per year.
Is coupon to bond as dividend is to stock?
That's a good way of thinking about it. I would say so. Not all stocks pay dividends, right, and not all bonds are going to have a coupon payment, but I'd say most of them will. It really depends on where you're looking.
I know when I first got into investing and I started talking to you about it, you suggested to me to not put as much money into bonds.
I said $0 into bonds, yes.
Yeah. So why is that?
Well, I think it depends for every single individual where you want to put your money. It depends how old you are and when you plan on retiring and when you want to pull that money out. And then it depends on if you have any financial obligations, student loans, credit card debt, that sort of thing. But, I mean, at the end of the day, if you're putting your money in an index, you're returning an average of 10% per year.
Now, let's pause for a second. What is an index?
An index is a collection of stocks that is being tracked.
So the most famous index is the S&P 500, right?
Debatable, but yeah. So there's the S&P 500, Dow, NASDAQ, Russell, right, countless more, nickel.
Yeah. And so that's essentially, you put your money in, you don't really pay much attention to that stock because it has historically projected an upward trend. It's not a very aggressive growth trend, but it is an upward trend.
What do you mean aggressive growth trend?
So when I think of aggressive growth, I think going up 150% within 2 years.
Okay.
That's not normal for the S&P 500. It's
not normal for anything.
No, exactly. No. So that's aggressive growth.
Yes. Aggressive growth also comes aggressive risk. Mm-hmm. So an index and an index fund are two different things. There's the S&P 500, which is an index, and an index fund is a fund that tracks the index. It could be an ETF or a mutual fund.
Okay.
That is an index fund. It could be broken into two groups, but that is separate from what an index is.
Okay, so what's an ETF and what's a mutual fund?
An exchange trade fund or a mutual fund. An exchange trade fund is something that is not actively managed. You're going to be charged a low rate for owning it, and it's just going to track a certain set of stocks. It could track an index. It could track a commodity. It could track all sorts of things.
Is a commodity just one individual stock?
No, a commodity is like gold, oil, that sort of thing. Yes. Mm-hmm.
Okay. And then a mutual fund is managed then by somebody?
It's actively managed, so you're probably going to pay a higher rate, but it's basically the same concept as an ETF, where it's tracking said set of securities, yes.
So when you go on to your brokerage account to make a transaction, how do you know the difference between an ETF and a mutual fund?
Well, I guess you would really have to research that for yourself. It'll say maybe on the ticker what it is, but you really have to research that for yourself.
So when you research stocks, how do you go about doing that? Because you always know the current events that are associated with a current ticker symbol. Which I never understood how you did that, because I never understood where you would just openly find this information.
I mean, that's a pretty broad question. And, how do I find out about stocks or find...
Yeah. I feel like it's a broad question, but it's like, how do people even begin to look? Because, okay, you have a niche market that you look at.
Yeah.
And I have a niche market that I look at. So then I narrow down that sector. For instance, I'm very into indoor farming and vertical farming and sustainability. So I look at that vertical and that industry so that I can understand, okay, what are the current events associated? What are some name players that might be looking to come into the market? That sort of thing. So that's kind of how I look at the market and how I look at investing. and I try and keep up on those current events. But with that, you have to be very cognizant about what's going on day to day, because it's not like a mutual fund where you just put money in and then it'll eventually increase. Like, you actually have to pay attention.
So yeah, buying individual stock securities is very different from putting your money in a ETF or a mutual fund, where it's going to be actively managed. It has a historical track rate, and you can kind of sit back and do nothing and never check your portfolio, and you'll be okay. Buying stocks, yes, definitely incredibly different. And I mean, how I learned about it, I think a variety of channels. Obviously, reading like the Wall Street Journal news, checking up on just financial apps like Yahoo Finance, different apps on my phone.
And how many times per week or per day do you do that?
I mean, I guess it depends. I would say, it used to be a lot more. It'd be every day I would be checking up on stuff like that. Now that I'm very busy, much less. But I'm also investing much less, not investing much less, but investing in individual securities much less, or new stocks that I don't already understand much less.
That makes sense. So how would you say that the ratio of your money is put? Would you say that the majority of that is put into like your 401k, and then
I'll say like how mine is broken down, but I, like anyone else, it would be terrible advice. I think it really depends on like who you are and how much you understand. And
so explain.
So I have probably, at this moment in time, I've probably if you looked at my portfolio 2 or 3 years ago, I would say it's probably 75% individual stocks that I'm holding, like probably 10 to 15 different stocks, and then 25% ETFs, mutual funds, broken up between value and growth. Now I've been pushing it closer and closer to 50 and 50, so a lot of my money has been going into ETFs just because it's simpler. So now I'm closer to I hold probably 8 to 10 stocks that are 50% of my portfolio, and 50% would be broken up between 2 different ETFs. One is tracking more growth sector, and one is tracking more value. So in different markets, they kind of perform differently and even out.
And so when you get your paycheck, how do you allocate towards investments? Do you allocate a portion of all of your paychecks to investments?
Yeah, I try to budget it out and save a certain percentage of my paycheck every month. Obviously, I'd say at the end of the month is when I move money into my brokerage account, and I try to track my expenses. And
so you're not really keen on that saying pay yourself first. You wait until the end of the month, see what your expenses are, and then go and invest based on what you have left over.
I would say right now, yes, simply because I moved to Boston 2 months ago, and obviously expenses are variable. I've been spending a lot of money in my apartment on other things, so I don't want to put more money than I can spare into my account.
That's fair.
And
so I did the same thing.
End of the month, look at how much I earned, how much I spent, and then figure out what it is. And I budgeted out beforehand before I came to Boston, like how much I'm gonna be able to save per month when I'm paying all this rent, yada yada. And it's held up pretty well, I'd say. But yeah,
it's a lot harder when you're moving to a new city and you're trying to make friends. For my whole first year, I recently just looked at my structure for my finances. But my entire first year, you're trying to make friends, you're trying to go out, you're trying to do things.
Oh yeah.
And so a lot of money spent. You don't want to be the person that says no, because as soon as you say no, then you're not going to be invited the next time, that sort of thing. So you're trying to do all these things with all of these people, and you're spending all this money. So I'm completely on board with not paying yourself first when you first move to a city. There's a point in time when your personal happiness and your personal relationships come before finances. And that's not to say don't live within your means, because you definitely should live within your means, but it is important to find some sort of balance in saying, okay, I know I can afford this, but it just means that I won't be able to invest this much money.
I would say it really depends on the person. If you have any student loan debt or credit card debt, that should be the first thing you address every time you have a paycheck. You don't need to completely resolve it or put all of your money there, but you should be addressing it bit by bit with every paycheck before you put money in the market and before you think about doing anything else. But if you're in a financially stable situation where you have a good job, you have no debt, you're, then that would be a little different. You can address it on the back end and enjoy yourself a little more.
So, what is the goal of investing? Like, okay, you're putting all this money into investment, you're watching it grow. Cool, great. What does that really mean? Like, what are these assets? How do they impact us now, and how will they impact us in the future?
So, I mean, the goal, I guess, differs a little bit for everybody, but the principle of it is that you're building for your future. You're saving money now, and you have to think about, I mean, compound interest is one of like the most important things that a lot of people never think about in their life.
Okay, so explain what compound interest really is.
So, if I make $10,000 this year and I let that $10,000 sit in my bank account till I'm 40, it's still worth $10,000. Although not even though, because with inflation it's probably worth about $2,000 when I'm 40, or has the purchasing power of $2,000 now when I'm 40. But if I put that in the stock market, my first year it grows at 10%. Now I have $1,100. And now $1,100 is going to grow at 10%. And now I have even more and more and more. And it's going to grow and just compound on top of it. And that money when I'm 40 will not look like $1,000. It'll be more like $10,000. Wait, I said $10,000 to start with. It'll be like $100,000.
With inflation, since you brought it up, how does that affect the stock market?
So inflation is really just prices going higher.
Right.
It's like the stuff like the CPI is what kind of inflation is based off, or what the inflation numbers come from. And that is really just prices going higher. Like your groceries all of a sudden are 10% higher. You're paying 10% more. Or we go out for a drink, it's 10% higher. Your rent is 10% higher, whatever. And that's really what inflation is. So you're still making the same $50,000 at work, but all of a sudden that $50,000 is not going nearly as far because everything is more expensive. And that's what inflation is. And inflation affects the stock market because it's just, I mean, the stock market is all about investor perception. Like, the stock market is based off how many people are buying and how many people are selling. That's like, so say I own 10 shares of Apple for $500 and I want to sell those 10 shares. And I go to my app and I want to sell these 10 shares, but there's not 10 people who want to buy it. I find 5 people who want to buy Apple for $500. Then all of a sudden, the stock price goes down because it has to match a buyer with a seller. Now it's $490. And 3 more people want to buy shares of Apple at $490. So I sell off 3 more of my shares and I have 2 shares left and it goes down to $485. And now 2 more people want to buy it. And I sell those 2 shares, and now Apple's a $485 stock instead of $500. So it's all about who is buying and who is selling in the market. And that's really just about perception about where the market is going and confidence in the market. And inflation definitely has a negative impact. The thing is, at the end of the day, is the best way to beat inflation is by letting your money grow. That, at the end of the day, is the best way to do it. But so you want your money in the stock market. Like with inflation, there's no better place for your money to be in the stock market, outpacing inflation, so that you are growing your wealth. But obviously, inflation does have negative impacts on the market. But in the long run, it'll work out and it will grow at the same rate.
So talking about investing in the market, there's 2 different kinds of markets, a bear market and a bull market.
I guess you could say that. I mean, a bull market is a market that is growing, and a bear market is a market that's declining. There's, I mean, I don't know, like during COVID, the market was jumping all over the place, and until it started declining, it was all over the place. Volatility, crazy, like, I don't know if I'd call that a bull or a bear market, just a weird market.
So what do you do in times like that? Do you just continue investing as normal and everything will balance out? Or
yeah, I mean, that's the best way to do it. Obviously, like, it's kind of scary investing because you see the market's down, 25% all of a sudden, and your money's worth a lot less. You look in your account, $100,000, all of a sudden you have $75,000. You're like, geez, where did this go? But you have to think about, it depends if you're owning individual stocks or ETFs If you're owning ETFs, you have to think about, in the long run, it will bounce back. And if the market is down 25%, then you're almost buying at a discount. You're jumping in when the market is cheap, and the market will bounce back. It could take a year or two, but it will bounce back and your money will grow.
So because the market is currently down right now, you would say that now is pretty good time to invest? Or
the market can obviously go lower,
right.
But I would say the best time to invest is the present. The golden rule is money, like time in the market over time in the market. You don't want to wait and let your money sit in the sidelines and then try and jump in when you think the price is right. Mm-hmm. You just want to be saving a certain percentage and, buying stock at like a low rate every week, every month, whenever you're doing it. If you're owning individual securities, it's a little different because obviously the market's down 25%, but you could have stocks that are still doing okay. You could have stocks that are down really bad. It entirely depends. And when you own individual securities, you need to be looking at each of them and saying, has the value prop changed on this stock? Is it still the same stock that I bought? Like I bought this at $10, it's now a $4 stock. Is it still the same stock then? Is it still the same value prop? Would I still price this thing at, $17 as my target price? And if the answer is yes, and nothing's really changed, then you should be buying all day long. If you still think that your stock is just as valuable as before, then you should be buying up as much as you can and averaging your costs down. And then if you look at a stock and the market's gone down and you think, oh, this stock in the market's not going to perform well, the value has changed, like their earnings were significantly lower than I projected, then you have to consider selling or moving your money elsewhere or not investing anymore and letting it sit.
With that type of investing, there's also investing with your company through a 401k. Mm-hmm. So what is a 401k and how does that differ from investments that I would make in my brokerage account?
A 401k it's an investment retirement account that is going to be managed by a third party or your employer. And I would say the golden rule is no matter like where you're working, if you have a 401k, whatever the company matches up to, always put that much in it because it's free money. You're putting 6% of your paycheck in and the company is matching that. You're just getting, free money there. And so the 401k at my last company, it was managed internally. I think it's a third party that manages it now, but it's basically the same thing as, having your money in a brokerage account and investing in stocks and growing it. It's just a set plan that your employer has.
What does your employer gain by matching it? Like, why do they match it?
That's a good question, and I don't know if I could speak on it. There could be regulatory requirements, but I think it's just part of the employment benefits. Like, why does your employer offer you healthcare? They don't need to offer you healthcare, but they do because it's more promising for employees to come there if they have good benefits, if they offer a 401k match, if they offer you healthcare and dental.
And then once you leave a company, so say your last company gave you a 6% match. Do you leave that 6% in there with that company, and when you're at the next company, that 6% is still in there? Or do you take that out when you leave? Like, how does that work?
You can do either. So you can let it sit there, and they're not going to do anything with your money. It's still in there, and they'll probably provide you with quarterly, annual updates, whatever you opted for, and it'll just sit there. You can roll it over into a new plan, or you can roll it over into your own personal account. But the big thing is that depending on what sort of money you've been putting in there, you may have to pay taxes to pull it out. So,
speaking of taxes when you pull it out, let's talk about Roth IRAs and what other retirement investment plans are there.
So Roth IRA is definitely a very helpful thing that a lot of people should be putting their money into. It's an account where post-tax money, you pay taxes, and then you're putting this money into the Roth IRA, and you're not paying any taxes on the back end.
I currently have 3 investment sectors in my portfolio, I guess. So I have my 401k, I have my Roth IRA, and then I have my individual investments that I choose where they go.
Yeah.
But you can also choose where your Roth IRA investments go as well, but you can't do anything with that money. Like if I wanted to pull that money out of the stock market that I put in I can do that. It's harder to do with your Roth. Like, you can
Yeah,
leverage your Roth to, like, for a mortgage or whatever, but why are there so many different areas to invest? If essentially it's all for retirement, like, it's all, like you said, for savings, it's all for growth, it's all for the end.
Yeah, well, it's all taxed differently. Like a Roth IRA, I think you can put $6,000 in per year, and then $12,000 if you're like a family where your spouse are earning money. You might have to check me on that. But yeah, it's all used for different means. Like a Roth IRA, you're paying tax on the front end, and you're on a 401k, you're also paying tax differently. So it's all kind of different ways that you can save for retirement.
And why are there caps on it? So I know for me, with my Roth, you're right, you can only put $6,000 in annually. Why is there a cap on it? Is it because they don't want people to take advantage of being taxed right now as opposed to later? Like,
probably.
What does the government gain from that? Like,
so
who is gaining from
right now,
that?
as opposed to later, when you're investing normally, you're paying tax now and later. Just as yes. So you have either a normal income tax or a capital gains tax, depending on when you're selling the stock. If I were to invest in Apple and I sold it 3 weeks from now, or if I were to be buying options, I'm paying my normal income tax bracket, and that's taxable income. If I sell stock after a year, I'm paying a capital gains tax, which is a lower tax bracket, and could be as low as you're paying $0 of tax. And I think it goes up to like 30%.
Okay. And since you brought up Apple, I just want to ask a quick question for clarifying reasons. So when you invest in a stock and a stock splits, what does that mean?
It's just they're dividing out the shares. If Apple has 100 shares for $500, they do a 5-to-1 split. All of a sudden, they have 500 shares at $100. So,
but what's the purpose of that? What is there to gain from that?
It's kind of advantageous because if you think of a stock like in Amazon, where it's a $3,000 stock. Now they have like stock slices. I don't know if you've heard that term, but company Robinhood and other brokerage apps have started doing stock slices. But before that, if you want to buy a share of Amazon, you need $3,000 to go and buy that share. When they do a stock split, all of a sudden do a 5-to-1 split, it's a $600 stock. And now it's much easier for some sorts of investors to invest in the company. You'll gather more investors and you'll drive the price up. So it's kind of just an artificial way to try and drive up value on a stock. So for the most part is the way I look at it.
Who decides when the stock splits? Is the company? Do the shareholders? Like, who decides when it splits?
The company decides, yeah. And of course, I mean, as a shareholder, you have voting rights depending on the shares that you're buying. But you have to, like, you don't actually get to make decisions.
Right.
Yeah.
But I mean, if you're Warren Buffett and you have the majority share at Coca-Cola, I'm assuming that you have to make some pretty executive
you can't have the majority share. It's a publicly owned company. So any company that's on the stock market, nobody has the majority.
Oh, really?
Yes.
Interesting.
Yeah.
But he owns a lot of it.
Probably, yes. I would assume a large margin, yeah.
I think that there's some sort of, I don't know if this is accurate. I think I just read this somewhere. It might have been on Twitter, so don't know how accurate it is. But Warren Buffett makes more annually from his Coca-Cola dividends than the CEO of Coca-Cola.
That wouldn't surprise me, yeah.
Yeah, which is insane because Coca-Cola is a massive company. But yeah, so that's just...
Yeah. Berkshire Hathaway is a bigger company, though.
That is very true. I looked at trying to buy a share of Berkshire Hathaway the other day, and I was like, absolutely not.
What's it, like $300,000 right now?
Yeah, something like that. Yeah, I was like, oh, okay. I guess I could buy a house with that. But when you start investing, what would you say some of the best practices for investing are? Like, with someone our age, what is the best things that they can look for, that they can do, that they can get started on? Say you're starting at square one. You know nothing. You have nothing, but you have $1,000 that you want to put somewhere.
I would say, everyone's different, but I'd say my personal approach for someone that doesn't have knowledge of the market, or kind of just any individual in general, would be to buy, mutual funds and ETFs. where you're not buying individual stocks with that risk associated. You don't have to actively keep track and look at a company's earnings quarter to quarter to see if it's still the same company you invested in, or if, oh no, I need to sell it. It's like they have major concerns. So if you're just putting your money in an ETF or mutual fund, you can kind of sit back, not check your account, and know that it is growing steadily for the foreseeable future. Unless something crazy happened, like America decided to completely collapse on itself. Yeah.
Well,
which I think we should be fine on.
With the decentralization of the U.S. currency, or just currency in general,
yeah.
with crypto, what does that really mean? And what does that mean for investors? Like, does that mean anything?
No.
No?
You're fine.
Okay.
Yes. Cryptocurrency is interesting, and it's, potentially a good place to put your money, but yeah, it's not going to have any effect on the U.S. dollar or on the stock market overall. Yeah. I think you'll be totally fine.
Are you invested in any crypto?
No, and I won't say I never will be, but I have no chance. When you look at the stock market, something that's been around for extremely long time, and annualize something like 10%, why would you put your money anywhere else when you can be, have this guaranteed thing that works? It's going to continue working. It's not going to change. All the major companies in the world, they're listed on the stock exchanges. Cryptocurrency is interesting, but cryptocurrency...
Do you even buy cryptocurrency on the brokerage market, or on your brokerage app?
It depends. I think more and more are starting to do that.
I think you can buy it on PayPal.
Yeah, most of it, I think you can do that, but I don't know for sure.
Well, Elon Musk owns PayPal, doesn't he?
He did. I think he sold it, and that's how he kind of kickstarted Tesla. PayPal was one of his first big things, I think.
Well, maybe. I was going to say that just makes sense because he's big into crypto.
Or at least he says he is.
What? Yeah. I don't know. But anyways, so back to square one with investing. What would you recommend doing first? So you have your $1,000 and you have your phone.
Probably educate yourself.
And how do you recommend doing that?
There's definitely a lot of bad sources out there that will tell you nonsense. I would say there's somebody like Dave Ramsey, who's kind of like a financial planning guru on the internet. He's like a reliable source. I'm sure there's a couple others, but then there's definitely a lot of places that will give you terrible advice, like put all your money in crypto, or start buying real estate and renting it out to people. Yeah, so a lot of places that will give you bad advice, but definitely try and educate yourself, and then put your money into mutual funds, ETFs, at something that you can afford. You should never be putting money into the market that you might need in the future. So if it should all be money that you are comfortable letting it sit there for 20 years. If I were to get in a car crash and have a bunch of hospital bills, I should not be forced to sell stocks to pay for that. Because that, I would say, is the one big, that's why people are big on bonds, because you're never going to be down 20% at a second in bonds, and all of a sudden you're forced to sell it, and you just lost all this money, like you might in the stock market. But with the stock market, you should be putting your money in there and knowing that you can let it sit for the long term. That if it goes down for a year by 30%, it doesn't matter, because I don't need that money right now. And in the long run, it will be up over any other kind of instrument that you can put it in. Other than maybe putting your money with a PE firm or VC firm or something like that you can't do if you're a normal individual.
Yeah, I was going to say, I don't think that I can take my money to a VC firm, be an angel investor.
Yeah, it's usually
a couple $1,000.
$1 million minimum or $500,000 minimum. Yeah. It really depends, but yeah, no, you can't.
No. That'd be cool, though. You'd be able to invest in a lot of companies.
Yeah. Well,
maybe we could do that as a startup. We can pool people's money.
There's people that have tried to do that, but I don't think the performance is there.
Oh, yeah.
They have, I think there's something called Titan Invest, or maybe it's just Titan, where it's like the hedge fund for the everyday Joe, where it's like they try and market themselves as a hedge fund, where they have experienced investment professionals running it and buying, selling securities for the everyday Joe, and I think their performance has been miserable so far.
That sounds about right.
So, at the end of the day, like an ETF or mutual fund is always better. Like you have hedge funds run by guys with 30 years of experience that don't outperform the market. And I would say that most hedge funds don't outperform the S&P 500 historically, is kind of like, which is kind of crazy to think about.
Right.
Yeah.
So educate yourself, invest in mutual funds and ETFs, and then after that, do you need to monitor your portfolio? Like, how often do you look at your portfolio and look and see the...
I mean, I look at it a lot, but I own a lot of stocks, and I would say that my portfolio is not exactly risk adverse. Like, I have a lot of, high risk stocks that are, they're still negative cash flow, like they're losing money every year and kind of trying to develop something. So obviously I have to be on it with that because like bankruptcy issues, solvency issues, and I have to understand if the value prop changes, because something like that can change fast, especially investing in biotech, which I have done a lot. When you have companies like developing drugs and doing clinical trials, all of a sudden they can release their trial data and you could say, well, shit, this company is not going to this drug is not going to go to market. It's not going to get FDA approval. And it's the value that was there before that I thought was there is no longer there. And I need to sell the stock. So for me, I definitely check on it a lot and try and look at company earnings for the companies I've invested in. And biotech, not so much the earnings matter, but more kind of data releases that they do every so often.
And so when you're looking at data releases and their quarterly reviews, what are you looking at? So what data are you looking at and being like, okay, that looks right, like I'm going to keep my money in here because I'm seeing X, Y, and Z?
I would just say kind of their like investor press releases, looking at that. They'll release stuff like, they have, stage 1, 2, 3 and what is going on there. Basically just kind of looking at it and seeing what the efficacy is for these drugs, kind of against what it was expected to be, and what is kind of the timeline, because that is something that definitely changes. A company you'll expect them to have like a 2-year timeline before they can sell this off to, a big company in the world like a Pfizer, and or try and take this to market with more capital, and then all of a sudden the press release will come out and you'll be like, this is still going to be in the pipeline for 5 years if maybe it never comes out. And that's kind of a big thing, I'd say.
So what happens if you're invested in a smaller biotech company and then that company is acquired and you're invested in it and that company is then acquired by a larger company like Moderna or Pfizer? What happens to that investment? Does that then get absorbed into Pfizer? And
Well, it depends on what the rate is, like what the price is that they pay for the company. If you have a small biotech company and Moderna or Pfizer wants to buy it or whatever, that's not like the CEO of the company can't just sell it. They need to get board approval, and the shareholders or the board is going to represent the shareholders and give approval to sell this company on their behalf. So hopefully as a shareholder you're going to get paid a fair price, because it's not like a $10 stock and a Moderna can just go and say, I want to buy this company at this price and buy out all these shareholders. It's kind of like they have to say, okay, we'll give you guys $25 for this, and the shareholders can either agree or disagree. And that's not an individual decision where I can go vote on my phone yes or no. It's kind of the board decides, and then you'll get paid out based off that. Put your money in the market. It's better than sitting in your wallet and try buying up stock. That's what I'm doing at the moment. Nothing else.
Great closing comments.
Yeah, super.
A Random Walk Down Wall Street is a book that you recommended to me. And why do you recommend that book?
It has a lot of basic info, I'd say.
So you would say that's a good book for beginners to understand more of the market and the terminology, the buzzwords.
Yeah, there's a lot of good stuff in there, I think, that you can learn about the market. And it's a good book. The thesis is kind of that an individual investor can't outpace the market, and that your money is best put in a mutual fund or an ETF, which to a certain extent I agree with.
And then are there any other sources that you found extremely useful? So I know you said Yahoo Finance is something that you used to look at. When you used to look at Yahoo Finance, what do you look at? Like, you see the plot and you see what's going on, but like, what do you really gain from looking at that?
I mean, you kind of understand what's going on in the economy, which is a pretty big deal. Like, you could be checking the Wall Street Journal, Yahoo Finance, which I still try to do very regularly most days. And
right, but when you
could understand like all the big things that are going on, the supply chain issues, the Fed rate hikes.
So that's where you get a lot of
oil
the current
prices.
events as well.
Yeah, exactly.
Okay.
And that can help kind of inform your decisions. Like, if you were checking in on, there was, what would this like be, like 2 years ago, there was that whole like riot at the Capitol, and kind of stuff like that. And I know people who kind of were tuned into that and started buying and selling gun stocks based off that and made money. And like, there's always kind of investment opportunity to be made when current events, as long as you're kind of tuned in.
Okay, and then I guess for more advanced investors or people that are more savvy with investing or are able to pay attention to the stock market a lot more than people that just want to grow their money in sort of a reliable way, you can short a stock.
Yeah, well, I guess
So
anyone that understands about shorting options probably isn't probably zoning out to every word I'm saying. But yes, you can buy options, you can short a stock, and there's a lot of different approaches you can take on a stock. Like a hedge fund, a lot of the times they'll hedge risk, which means to kind of diversify and break up your risk by putting in a short position on a stock that they have a lot of or writing options on it. And that basically means the inverse of buying a stock. When you are shorting it, you're thinking that this stock is overvalued and I think it's gonna regress to its fair value or go down. And there's certain levels of risk with that. Like, I don't know if you heard about the whole Reddit thing with GameStop. Yeah, there's a lot of risk associated with shorting a stock, because if a stock goes up, you could be paying premiums on your position and giving away money to banks, tossing it down the toilet basically. And there are options where you'll also be paying premiums, some very serious premiums, if depending on the options you're buying.
So going back to Reddit and going back to getting information from reliable sources, so a lot of people did make money on GameStop, but a lot of people did lose money on GameStop.
Oh, yeah. Mm-hmm.
So when you hear things on the news, because I know, what is it?
Yep.
So the CNBC news is always on, it's always talking about stocks, and almost immediately after a segment on one of those shows runs, there's an immediate increase or decrease in that specific ticker symbol. Or,
what do you mean?
Like, after people have presented information on it, there's almost an immediate response based on what they just
Yeah, because
spoke about. So
the stock market's driven by demand.
Exactly.
Supply, yeah.
So how should people be kind of wary and careful about that information?
That's why I would say, another reason why I would say, just put your money in ETF and you'll never have to worry about it. But yeah, it's definitely a significant thing, like what you saw with Reddit, where the hedge fund lost half of its value in a couple of days, in a week, which is kind of crazy to think about. But yeah, I mean, at the end of the day, a stock's value is not determined by their earnings, how much money they're making. While that may have a major impact and be the driving force behind the stock, and it usually is, it's driven by how many people want to buy and sell it. So if all of a sudden thousands and thousands of Redditors start getting together and saying, we're going to buy GameStop, that's going to drive the price up, because all of a sudden you have thousands of buyers not connected to, and there's less sellers ready to sell the stock at a certain price. So yeah, I mean, definitely information displayed out there is a big thing, and that's why I would say that a stock like Apple is it's probably at a much fairer value than a stock like a tiny little biotech stock or tech stock that's just getting out there, like a penny stock, because when there's all that information circulating, when you have all these analysts covering a stock, like a big S&P 500 stock, it's hard to find value there because it's being priced out so much by all these people that are you really going to see something there that they are not? Are you really going to find value there that hasn't already been taken into account?
And then kind of going off of that, I know you talked or touched on penny stocks. Those are the pink sheets that are in Wolf of Wall Street and all those tiny, tiny companies. So what is a penny stock and why do people invest in them?
I mean, penny stocks, I don't know too much about it. They're really stocks that should not be on the stock market. And
well, I know with Fidelity, at least, they give you an advisory about investing in penny stocks, and then they make you call in.
You can't. So most brokerage apps won't let you buy them, and you really shouldn't be buying them because at the end of the day, I mean, they're companies that should never be on the stock market, and they're massive risks. I think I invested in like one. Oh no, I didn't invest in it, but it was a Canadian esports gaming company that actually did very well, but I never ended up buying it. Yeah.
What ultimately makes or breaks whether or not you're going to make an investment?
What makes or breaks
like whether? If you're looking into this company and you're like, I think I'm going to invest in it. What is either the force that drives you to end up investing, and what is the force that maybe prevents you from investing? So you just said that you were going to invest in that esports Canadian whatever, but then you ultimately ended up not. So what was the driving factor and why, for instance, you may not invest in a company like that?
Yeah, well, I think a lot of it is the risk and return. It really depends on what kind of investor you are and what approach you're taking to it. If you're like, for me, a lot of the times I will build like a financial model on a stock and try and price it out. So that means that I'm looking at their previous revenues, their expenses, all of that, how much debt they have, whatever. And I'm trying to project into the future what it might look like for the future and find a stock price based off what their future earnings are going to be. And there's a lot of ways to do that. One of the big ones is probably DCF. It's kind of looking at that based off the risk because it really depends on the stock. But I mean, with a lot of the stocks I invest in, they're not that big. They're not profitable yet. And it is difficult to kind of look at the future and say, what is this company look like? What are their earnings going to look like in the future? And you can kind of look at that backed up against the risk. I would say especially with especially one of the big things that I think about is kind of how much cash does this company have? How long is it going to make it when it's a small company? Like if you have a company that's losing money every year trying to develop something or taking it to market, they're going to have a burn rate. And you want to look at the company and say, with how much cash they have, how long are they going to make it at the current rate they're burning money? And then you have to look at, okay, are they able to take up more debt, or are they able to offer stock so that they can keep going beyond that? Like, what does kind of their balance sheet look like? Like, do they have debt through the roof that's repayable soon? And like, then, that's a bad situation. You want to stay away. Or does this company have low debt and they have enough cash to make it? And do you really like the platform that they have and think that this is a successful thing and think that the stock is not priced through the roof? So I guess that's kind of the other part, is looking at a company, but then looking at what the current price is. Because as we've seen in the market, and we've seen stocks drop off the map like crazy, especially in the tech space, because tech's been so overpriced, is that you can find a really great company and a really good company, really great product. It, is competitively advantageous where it has like a great position in the market, and it's kind of, it's not going anywhere. It's going to keep growing. But then the problem is you have to look at that and then look at the stock price. And sometimes you can find an amazing company and it's just priced through the roof, and you have to be wary of that. Looking at kind of the metrics behind it, like what is taking into account the stock price? Like, are they pricing off like ridiculous growth numbers up into the future? Like, what is the PE ratio? And that's like a big thing with like the Tesla bears, is they say like the Tesla stock, like I guess now it's probably down a lot. I don't really track it too much, but if you look at it like a year ago, people were saying and have been saying there's been so many bears, and it's been such kind of like a different situation where there's so many people that are so bullish on Tesla and so many people that are like, okay, let's look at this. They're pricing in ridiculous growth rates. If you look at it, the market cap is bigger than every other car company out there. Like, they're pricing in a Tesla taxi service baked into the current price, like all these like ridiculous like concepts. And you have to think about that. Kind of say, okay, the stock price has all these baked in. It has massive revenues going all the way into the future already baked in the stock. It has Tesla offering a Tesla taxi service already baked in the current stock price. So before I go and buy Tesla, let me just think about if that makes sense and if that is fair value for where the company is right now. If I should be thinking that they should have all this stuff baked in the stock.
The main takeaway and what the closing comment could be is that...
Was that my closing comment?
I think that was good. I think that it was
dear.
No, but it's a good theme for you to not just, oh, I like Tesla. Tesla's a good company. I think that they're going to do well.
Yes.
It's more than that.
That's a big thing, because I feel like you always talk about stocks and you're like, I love this company. It's great. It's like, okay, it can be a great company, but if you think it's a great company and all of a sudden you've had this epiphany, Peloton, I love Peloton. It's a great company. You just have to think about how many other people out there have already thought that exact idea and then say, let's look at the stock price. Whoa. Apparently everyone in the fucking world thinks Peloton's a great idea because this thing is priced through the roof for what it actually is. And so you have to, kind of think about what are great companies, but then what are great value companies. And that's kind of the difference between growth investing and value-based investing. Value-based investing, you're not investing based off a company's growth and what you think they're going to be. Looking at a company, I guess you could call Tesla, and saying, wow, look at what it's going to grow to be. I'm expecting massive growth from this company. It's going to grow 40% year over year. And that's a growth-based investment because you're buying money into what you think is going to grow really fast. And then you have value, where you can say, like Warren Buffett, that's kind of his moneymaker, the value-based investing. And he says, okay, Coca-Cola, been around forever, get up, be here. I think Coca-Cola is undervalued at the current price, so I'm going to buy it. I think that it's not going to keep growing fast. The revenues will stay pretty similar, maybe grow a little bit, yada, yada. But I think it's underpriced for what it currently is.
So essentially, value-based investors make their money when other people look at that value-based investment as a growth investment. So then it drives the price up. So then value-based investors are making the most amount of money.
No, I would disagree with that. I'd say it's more... not based off that. I'd say it's more based off market inefficiencies. Just the market improperly pricing stocks. Like just taking a random company and the market's priced at $120, but you're looking at it and on the basis of its current revenue and how it's been in the past, you think it should be $150, and especially with how that revenue is going to change in the future.
Overall, you can't trust anyone else's advice on investing. You have to look. So
definitely don't trust mine.
So don't listen to a word we just said. Delete this last hour from your memory. Make your own decisions. Don't be influenced by other people's opinions. Ultimately, you can become informed by learning about other people's opinions, but don't invest merely because other people are telling you to invest or because that is what other people have told you is going to give you the best growth opportunity and you're going to see the most money, blah, 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 blah. Because odds are they invested at a much lower point than you did, and you buying it now is only helping them. But anyways, so thank you so much for coming on, Brett. I truly appreciated all of your insight.
Very welcome.